Welcome to Unit 1 of Accounting 250. Before we get started on any lectures, I just wanted to give you a bit of an insight on what's going on this side. Periodically the lights are going to go off and I have to wave my hand so I'm not looking like some crazy person. So if it goes dark and I start waving, that's what's going on. And then the other thing is I have a stylus that I'm using, and it's going to look like I'm about 3 years old writing on these papers. So bear with me. Hopefully they won't be too difficult to read. Okay, so with Unit 1, with all of our chapters, what I would like you to do is have your handout printed out and in front of you or somewhere available if you don't want to print it out, but basically available and ready to go so that you can follow along and do work with me. I'm going to pause and give you time to do work while we're going through it. So having it available to do that work was going to make this experience a whole lot more beneficial to everybody. So before we do get started on actual time with the topic of accounting, I have a preliminary exercise for you to do, to go through and to try to figure out. So this first topic is classic upholstery. So we're going to be looking at item number 1 here. And I will go ahead and read it with you, and then I will set you on your way to give you a few minutes to work on it yourself. So Tyler Smith has worked in an upholstery shop for 10 years. Last year, his wages were $20,000. Lately, he's been unhappy with the shop's owner, and he's convinced that he could run the shop better and at a lower cost. So he decided to go into business for himself and open Classic Upholstery Shop. To get the business going, Tyler decided to invest heavily in advertising. He spent $6,000 on advertising aimed at customers and another $2,000 aimed at getting work from interior decorators and interior design stores. He also purchased industrial sewing machines costing $4,000 and other tools and equipment costing $3,000. He estimated that the sewing machines can be used for up to 5 years before maintenance costs would be too high and machines will need to be replaced. The other tools and equipment are not as durable and will have to be replaced in 3 years. At the end of the first year of business, he received $80,000 in cash from customers for upholstery work. He's owed another $2,500 from customers who are not required to pay cash but are billed every 30 days. A review of his checkbook shows that he paid the following expenses in addition to the ones we've already talked about during the first year. So we've got this list here. Tyler's utility bill for the last month of the year has not arrived. He estimates that the bill will be approximately $320. He keeps some stock of upholstery fabric and popular colors on hand for customers who don't want to wait for special order fabrics. And at the end of the year, about $14,000 of fabric purchased during the year was in his store stock. In addition, $2,300 in supplies had not been used. So the question here is, how much profit did Tyler make in his first year of business? So go ahead and take a few minutes, try to figure this out. Pause this WebEx, and then come back and we will talk about the right answer. Okay, so how much did Tyler make in profit his first year? Now, the first thing that we want to talk about is what is profit and how is that measured? And up to this point, well, we haven't had any discussions on that, so that is kind of difficult to talk about. But usually when I do on-ground classes, I have, let me see if I can get this to work. Here we go. I have anywhere from answers ranging from negative 12,000. I've also had answers of negative 32,000. I've had answers that range into the positive range of up to $65,000. Now, an important thing to look at here is, would Tyler care if it was a positive $65,000 or a negative $32,000? Would he care? And for most of us in our daily life, we would definitely care if we made money with $65,000 or if we lost $32,000 worth of money during the business for this year. So really the point of this exercise is not to test your accounting knowledge, but really to emphasize that there are standards and rules in place for accounting so that everybody does things and looks at the transactions in the same way, records them the same way. And instead of having a range of almost $100,000 difference between this high and this low, instead of having that difference, we would have, well, almost exactly the same, if not exactly the same answers. So knowing these rules, knowing these principles is the foundation of accounting. It's the foundation of business. So it's important to know what these rules, what these principles are, and that's what we're going to be learning in this class, learning these rules and these principles. So for today, and only for today, there is no correct answer. At the end of 250 and 251, we should be able to revisit this and come up with the right answer. So that is the teaser questions, I suppose. But for now, we're just going to say that it's important to know the rules and apply them properly every single time. Okay. Now our next order of business is just to point you in the direction of different careers in accounting and the importance of accounting as a business tool. So the importance of accounting tells us that accounting has a major role in business. Accounting is the language of business, and without it, we can't really talk intelligently about what's going on within our business. So we have to understand accounting no matter what our profession is, whether we're a salesman or a manager within the marketing department or a manager in the warehouse, because accounting is how our results are shown. So if we have good accounting knowledge, then we have a good chance of being able to work through any deficiencies or understand how well we've done. So accounting is the language of business. And every successful businessman that I've known, businessman and woman that I've known, has had an excellent understanding of accounting, whether it's been through an actual education in accounting or just their principles of accounting class that they've been able to apply to the larger business setting. So we've got the role of accounting in business, and again, accounting is the language of business. You can't run a business without numbers. So that's important. We're also, again, like I said earlier, we're going to talk about opportunities, careers in accounting. We're going to talk about fundamentals of accounting, including ethics and GAAP. We're also going to talk about transaction analysis and the accounting equation. And then we're going to talk about financial statements. So it's a few minutes in, but that is the roadmap for the rest of the videos here in Unit 1. So as far as careers in accounting go, there's several major career areas that you can enter into if you want to be an accountant. Your book does a good job of explaining those things. There's also supplemental materials and websites that you can go to within Blackboard and I definitely encourage you to do that. But just a quick list of career paths is you can go into public accounting like I did and do audit work. You could also be a corporate accountant, so go within a company and do their accounting work, anywhere from the accounting clerk all the way up to the CFO of the company. You can be a consultant, a stockbroker, a banker, an analyst. All of those career paths are very heavy accounting oriented. So that's just a quick overview of the different careers that are available in accounting. And if you have any specific questions, you can either visit the websites on Blackboard or you can contact your professor. Okay, so some fundamentals of accounting. And one of those fundamentals is ethics. So here we're going to talk a little bit about ethics. And really it's very, I can't even tell you enough how important it is for business people and especially accountants to be ethical. We have had in the past, since about 2000, some major accounting debacles that have happened. So you've got anything from Enron, WorldCom, Global Crossing, all of those things that happened in the 2001, 2002 era, all the way up to anything that happened leading up to the recession from 2007, 2008 that at the time of this video is still going on. So all of those sorts of business debacles typically boil down to a question of ethics, and are we actually accounting for things in the way that they should be accounted? Are we being honest and ethical and doing the right thing? So really, a lot of it has to do with conscience. So can you look at yourself in the mirror? Can you sleep at night? Is a dishonest, unethical decision weighing heavy on you? Another thing is that illegal acts hold some serious consequences. So it's anywhere from fines to jail or prison time, and let's be honest, nobody wants to do that. So going back to Enron and those big major debacles, a lot of people got some serious jail time. Even, the latest Ponzi scheme with Madoff, amazing millions and millions and millions of dollars, and he actually blew the whistle on himself because of his conscience. But as a result, he has a prison sentence of over 150 years. And, he's not going to make it out of there alive. A lot of people from Enron, well, not a lot, but at least one or two actually killed themselves over the ordeal because it weighed so heavily on their conscience and they couldn't deal with the consequences. So it's very important to have ethical decisions in your life and especially in your business. Now here, with our ethics cases, we've got 4 cases, and that's actually one of yours, so we're not going to cover it here, but it is included here for your reference. Then we have some basic accounting principles, and currently our accounting principles are set by the Financial Accounting Standards Board, FASB, and they're called Generally Accepted Accounting Principles, GAAP. So we have GAAP. And I'm going to refer to GAAP a lot over the course of Accounting 250 and 251. But some major overriding principles that you have in GAAP are these few principles, these 6 principles. There's many, many more, but these are some overriding principles that everybody needs to understand. So review them from your book. I'm going to go over them rather quickly. The objectivity principle states that financial statements are supported by independent and unbiased evidence. such as invoices, shipping, receiving documents, those sorts of things. The cost principle says that financial statements are based on actual costs incurred in business transactions. So we go on actual cost and not some market value that can be increased or decreased based on market conditions. So this is actual cost or historical cost. The going concern principle states that, as a general rule, we consider that when we're talking about a business, it is a continuing operation, and it will still be in business at least 1 year from now. So it is ongoing. It's a going concern. And the monetary unit principle means that we can express our financial statement in monetary units or money. So we use dollars or yen or euros or pounds or any monetary unit. We don't use camel and sheep and bushels of wheat and things like that anymore. We use monetary units or money. Revenue recognition means that revenue is recognized when it's earned and not necessarily when the money is received. So that's going to be an important one that we revisit throughout these two classes. And then the business entity principle means that a business is accounted for separately from its owners. So it has separate bank accounts and separate accounting systems and everything. It's not the same as its owners. And you can read through the book about the different ownership interest types. So we've got different businesses, manufacturing, merchandising, and service. But then we also have different types of business organizations, such as the sole proprietorship, partnership, and corporation. So for our purposes, go ahead, read through the book. Make sure that you understand the differences between the three. In Accounting 250, we're going to be concentrating on the sole proprietorship form. In 251, we will talk more about corporations, but for the most part, we will be concentrating and focusing on the sole proprietorship. Okay, our next set of items is transaction analysis and the accounting equation. So with transaction analysis and the accounting equation, we have to know several things. We have to understand what assets are, what liabilities are, and what owner's equity is. I didn't mention it earlier, but for our purposes in these two classes, you are not going to be required to memorize definitions and regurgitate them on a test. What you are going to need to do is understand the definition of the words and then be able to apply that into a business setting, into transactions. So you don't need to know the three-point definition of an asset, but you need to know how to identify an asset and what it represents, those sorts of things. So no need to memorize, just understand. Okay, so that is the same as these definitions. You don't need to memorize these definitions either. Okay, so back to assets. So assets are resources that are owned by the business. They're owned by the company. And that can include any number of things. So assets are things like cash or inventory, or accounts receivable, anything that the company owns. So those are a few examples of assets. And then we have liabilities. And liabilities are the rights of creditors to the business, or in other words, what we owe to others. So liabilities include accounts payable, accounts payable, wages payable, and I'm going to abbreviate that, WP, wages payable, mortgage payable, bonds payable, notes payable. Just about anything that ends in payable is going to be a liability. So that's not a hard and fast rule, but it'll work for you 90% of the time. So assets are what we own, liabilities are what we owe, and owner's equity is the rights of the owners to the business. It's the ownership. The ownership of the business. So this includes profit or net income, and I'll usually abbreviate that, net income. So profit, net income, those sorts of things. That is the retained ownership of the company. And all of these things are related to each other in our accounting equation here. Assets equals liabilities plus owner's equity. A lot of people think accounting is math, and, well, I guess it kind of is. It's math-based, but here we have our very own accounting equation. And we take much, much pride in the accounting equation. And it is very similar to any other equation in the field of math. But before we talk about that, I do want to clarify owner's equity. And really, a lot of people, when they think of equity, think of home ownership and the equity or negative equity that people have in their homes. And while that can work as a method of understanding equity, basically it's just what's left over after we pay all of our liabilities with our assets. So it's a residual. So assets minus liabilities equals owner's equity. It's our ownership interest in the company after we've paid for all of our liabilities with our assets. So don't think of home ownership and market values and all of those things when you think of owner's equity. Think of ownership interest, residual interest in a company. Okay, so the accounting equation, again, is just like anything in math. We have two sides of the equation, and whatever we do to the equation needs to stay balanced. So what that means is that every single transaction has at least two parts or two areas. It could have more than that, but it has to have at least two. So we can illustrate with a couple of examples. So the first example, let's say that, where am I here? Let's say that the company buys a delivery van. Buys a $20,000 delivery van. And it finances it. So let's just erase this because this is getting ugly. We buy a $20,000 van and we finance it. Now, how does that work within this accounting equation? Well, the way it works is that we're buying an asset. So the accounting equation, we have assets of $20,000, and then we finance it. So that means that we owe somebody. So that means that we have a liability of $20,000. And then we don't have any owner's equity associated with this particular transaction. But $20,000 equals $20,000. And we can do that for any sort of transaction. We can have 2 equals 1 plus 1. We can have 1 minus 1 equals 0. So any sort of combination of transactions, as long as one side of the equation equals the other side at the end, everything is good from the accounting equation perspective. So let's do a little bit of a more complicated example and say, let's say that we buy a $30,000 truck, and when we do that, we pay $5,000 cash, and we finance the rest. How does that work in our accounting equation? Assets equals liabilities plus owner's equity. So the way that works is we bought a truck, so now we've got $30,000. We have $30,000 on the asset side, and we pay $5,000. So we're actually also decreasing $5,000 cash. So cash is an asset, and we're paying it out, so we're decreasing. And then how much do we owe on the truck? Well, we owe $25,000. So if we look at it, we have $25,000 equals $25,000. And our accounting equation balances. And that is a significant thing associated with accounting, is always having this accounting equation balanced. X equals X. So one side equals the other side. Hopefully that makes sense, because we have a bit of a more complex example. And I'm actually going to put that onto a different WebEx, because that's going to be significantly more time associated with it. But in the process, go ahead and read through this, and then I will see you on the next video.